been a while since I've talked about an impending real estate market crash, so here we go. This video is going to go over some of the major bearish and bullish factors that could affect the housing market in the coming years and even coming months, since there are a number of different things that could happen. There's no telling which one actually will happen, but hopefully this gets you thinking about the situation. What you do with this information is entirely up to you, and it is not financial advice. Anyways, let's get right into it and talk about the bearish factors that could affect the housing market in the near future, starting with perhaps the most obvious one, and that is interest rates. Very recently, we got news from the Federal Reserve that they are moving from thinking about raising rates in the future to talking about raising rates in the future, which I guess was a national headline since the markets moved kind of dramatically right after they heard that news, but things have remained relatively stable. But in short, the Fed is predicting that sometime around late 2022 or into 2023, it's probably going to be raising rates. That's what they're saying. There's no telling that they're actually telling the truth or if they're actually correct in that prediction. It's just a prediction after all. But in any event, because of all the debt in the system, interest rates play a huge role in real estate pricing, and that especially goes for the single-family home market. It's not a coincidence that in 2020, when interest rates were slashed significantly, we saw a major rise in real estate prices across the board. Granted, there are plenty of other factors as well, which are going to be still relevant today. But when interest rates are lower, that means that people can afford more home. And because of that, that's going to drive prices up. And the reverse is true as well. When interest rates go up, you're going to expect housing prices to go down because now debt to buy the home or buy whatever piece of real estate you're trying to buy, that is going to be more expensive because the payment that you're going to have to make is now going to be more expensive as well. Even if rents might stay completely the same, the interest rate can have a very major effect on the actual affordability of housing and thus the price. But on the flip side, many people are locking in very low interest rate loans right now at something like 3% or even below 3% per year, which is pretty insane. So even if interest rates go up, those loans would be fixed, so the payment would be the same, even if housing values actually come down. So what I'm really trying to say is that anyone with equity in their home right now, who otherwise has a very low payment thanks to low interest rates, would potentially see a lot of that equity go away, and at the same time, the actual price to get into a new home would lower as well if interest rates were to rise. But that's a very tricky one to predict because that is closely related to the Federal Reserve's activity, what they end up doing, and they could do a number of things, whether they keep the printer press running and keeping interest rates super artificially low, or they can tighten their monetary policy to allow interest rates to rise to combat inflation. We'll see what happens. It very much remains to be seen how that is going to go. But speaking of debt, let's get into the next bearish factor, and that is forbearance. The pandemic and the government action that came after it brought with it a very significant amount of forbearance options for homeowners. Now, forbearance generally refers to when a lender will allow a borrower to pause payments on their loan, and typically the lender will then tack on the paused payments at some point in the future. It's an alternative to foreclosure, and the idea is that it allows the homeowner to stay on their feet, catch up when they're behind on payments. Maybe they lost a job. Obviously, there was a lot of instability when the pandemic first hit and into the summer after that. So the government stepped in and said that anyone with a government-sponsored mortgage, more or less, which is most of the mortgages out there, those people would be able to take forbearance as long as they asked for it. And there are millions of homeowners still on forbearance, not nearly to the level that we initially had when this program was first enacted, but we're still at 2.2 million in forbearance right now, which is about 4.5% of all mortgages, so a very significant amount. And the reason this is a bearish factor is because this has to end at some point, and many of the forbearance programs should be expiring quite soon. However, the government could extend those, which I'll talk about in a bit. But the fact remains that there are probably a number of people who currently are taking forbearance who otherwise would be getting foreclosed on if this were a quote-unquote normal time. And if that were the case, there would be significantly more supply in the system, and that could be a bearish factor on real estate prices. However, it would potentially make things a lot more affordable for everyone because there'd be more supply. That is the big issue in this market right now that's driving up prices so much. There's just such little supply relative to the really pretty usual demand that we see in the housing market. As I've covered on this channel before, the number of transactions last year wasn't much different than the year prior. The difference was that there were drastically fewer listings available, and because of that, you had about the same number of buyers chasing way less supply, and thus you got this huge price increase on top of the interest rate cuts and on top of some other problems that led to more supply issues. But anyways, it's hard to tell how many of the 2.2 million people on forbearance right now, how many of them are vulnerable to foreclosure. I'm sure there's a number of people in there. It's hard to say exactly, but it's definitely something to keep an eye on, especially as these programs expire. And as for the next bearish factor, because I mentioned input costs, let's talk about those. You've probably seen quite a few memes by now about the absurd prices of lumber and how expensive that has gotten. It's doubled over the last year, something absurd like that. You have all the new money that's been flooded into the system and some supply issues at that with lumber. So you got a lot of things that would drive prices up there too, yet you still have consistent demand to build new housing. Well, there are signs that supply might be catching up with demand finally, or at least more than it was before. And that would mean that input costs would be lower. And that would mean that new houses would be cheaper to build. And that would mean that the price of new houses would theoretically be lower. And because those would be lower, that would be a catalyst to lower prices on older homes, trying to be competitive, and you'd get some price movement that way towards the downside. In other words, if input costs go down, the price of new housing would also go down, and that would mean the price of housing in general should also go down. We'll see what happens to commodity prices over the next year. This will be a big year in what happens with all the supply issues that came about because of all the restrictions from the pandemic and the number of things that threw a wrench into supply chains all over the globe, really, not just in the US, but everywhere. We'll see how much supply recovers over that time. But that idea of competition potentially bringing down prices when new homes come online, that leads to this next bearish factor, and that's high prices. Ultimately, the solution to high prices is high prices, and the chances of interest rates getting any lower are very slim. In some markets, housing costs have gotten so high that it's outstripping demand, and when that happens, no one's going to buy the thing that is priced at that price. This is not just in real estate, but in anything. When something gets too expensive, you're not going to have enough people who are willing to buy it at that price, and the only way to sell it would be to lower those prices. So high prices are a solution to high prices. It just takes some time. The question is, are we really at the capacity for prices in the real estate market? It's hard to say exactly where that is, since it depends on incomes, it depends on interest rates if they stay the same, it depends on a lot of things. So whether we're there, it's hard to say it, and it's probably a very local determination to make, since typically what happens is in expensive markets, they might get so expensive to where institutional buyers, investors will look towards out of state, and homeowners as well will move out of state if things get too expensive, and they'll go to some other location that's cheaper, and people will generally vote with their feet, though that again can take quite a bit of time. It could take years even for that really to take shape. But ultimately, that's a pretty significant bearish factor. It's the high prices themselves, and it shouldn't be overlooked. And even though, generally speaking, housing prices have gotten very high across the board, it's important to look at some of the bullish factors as well that could continue to push them higher, since that is not out of the realm of possibilities. But before I get into those bullish factors that could push housing prices even higher in the coming months and years, I definitely want to encourage you guys, if you haven't already, to hit that like button if you're getting value out of this, and to hit the subscribe button as well, and the bell notification, since a number of my subscribers do not get the bell notifications apparently. So definitely do that if you haven't already, so don't miss any new updates. I put out new videos every single week as they have to do with investing and personal finance, and definitely wouldn't want you guys to miss out. But anyways, let's get into those bullish factors, starting with input costs. I know we've already talked about input costs on the bearish side, in that if the prices of lumber and all the inputs into housing go down, then the price of housing should also go down, because high prices defeat high prices over the long term. So that would be a major consideration there. But it also is relevant to the bullish side as well. If input costs go up even more because of all the Fed printing, and the input costs go up because of supply issues or whatever it is, that could push housing prices even higher, because it'll be harder to create new housing at a more affordable price. This is definitely a hard one to predict, since it depends a lot on monetary policy, how much inflation we get, since that typically will go directly into input costs for everyone, including home builders, and that would make housing more expensive, which I guess we would call a bullish factor, even though it sounds pretty negative on the surface for sure. And speaking of the Fed, let's talk about monetary policy. So long as the Federal Reserve continues to flood the system with money by buying pretty much everything it can get its hands on, from mortgage-backed securities to government debt to whatever it can buy, that is probably going to lead to a lot more inflation in the future, and that would mean that housing prices and pretty much the prices of everything would continue to go up so long as we get that great inflation, which could come with a lot more monetary activity from all the new Fed printing that we see. And with all the government stimulus programs, from boosted unemployment to the actual stimulus checks and many other things, there is definitely an argument to be made that there's a lot of money that hasn't really made its way through the economy that the government has produced, and that could lead to an inflationary spiral even if the Federal Reserve stopped quantitative easing today, since that money hasn't really made its way through the economy. And that would bode well for housing prices, but it'd really lead to a price increase for probably a lot of things. So another one of those weird sort of bullish yet bearish factors. And while we're talking about the government, let's go on to the next bullish factor, and that is government programs being extended. This definitely applies to forbearance programs. If the government keeps extending those mandatory forbearance programs, that could certainly be a catalyst for keeping prices high. Same goes for foreclosure moratoriums. This isn't just at the federal level. A lot of states have their own programs as well to keep an eye on. So again, the local issues that relate to real estate are very relevant, of course. But the government could also add in new home buying programs where they flood the system with money that way, where they give new home buyers more money to spend on housing, and that would push the price of housing up more since people would have more money to spend on housing. And the government has certainly shown us that it is not afraid to spend quite a bit of money in a very short period of time. This one's very hard to predict, at least in a general sense, because a lot of it is local issues with states and cities, but also because it relies on politics. And in many cases, politicians will say that they're going to do something, and then they'll do something completely different or nothing at all. Anyways, let's talk about the next bullish factor, and that's the economic recovery that we could be getting very soon. This is a weird one, since I would definitely say that the economy is in a much worse position than it was a couple years ago. However, there is some signs of hope that things are getting better for the near future. We're seeing a lot of the pandemic-related restrictions getting relaxed now that we've seen so many millions of vaccines finally getting administered. So that bodes well, since people are going back downtown, they're going back to the office, they're shopping, they're going to restaurants, all things that would bode well for an economy, rather than people staying at home, not working, and potentially collecting government money while they're not actually producing anything. And I don't blame people for doing that, but that is not a sustainable thing for an economy. As people start working again, you'd expect them to be able to qualify for mortgages again. They would then be in the demand pool for housing, and that would push housing prices up as well. So long as the economy continues to improve, you'd probably expect housing prices to go up as well, as more people can actually qualify for mortgages. That would be my guess. And this next bullish factor is actually related to the high price thing I mentioned earlier, and that's about rent yields. A rent yield refers to the amount of rent that a property can get based on its price. So the lower the rent yield, that means that the rent is lower compared to the property price than it might have been before. Typically, you would expect rent to keep up with real estate prices, but sometimes real estate prices rise so quickly that rent doesn't really have a chance to keep up with it. And that could be because of a number of factors. For one, rentals are typically on year-long leases, so there's some lag there depending on how a market kind of orients itself. A lot of leases might end in the summer in a colder climate, for example. But typically when rent yields get too low, it becomes a lot less attractive for an investor to buy that property because you can't get enough income to pay for the expenses on that property because it's too expensive. So if rents do start going up in many markets, that would potentially drive more investors to buy more property, and that would in turn drive up the price of real estate again. But like I said, there's often quite a bit of lag there, so we'll see what actually happens with the rental market. So those are the bullish and bearish factors I wanted to highlight. Definitely, if you think of some other factors, leave them in the comments below, but I do want to mention a couple of caveats with this whole analysis here. I already mentioned it earlier, but remember that real estate is a very local thing. Even though you'll see national home prices rising, that might be very different depending on what market you're in. You might see explosive price growth in your area, or you might even see a price decrease even in this otherwise hot market nationally. The point is, every factor is not necessarily going to affect every area in the same way. And another caveat to watch out for is the eviction moratoriums and the rental market, which I was kind of alluding to with that last bullish factor. That is kind of a wild card here that could affect things in a very big way. There are a lot of eviction moratoriums right now which have probably distorted quite a few rental markets, and that could affect real estate prices when those moratoriums end, or if the government decides to put a bunch of money into that. There's some massive rental assistance programs that are starting to get unveiled, so we'll see what happens there. But that is another factor to keep an eye on that could affect things in a pretty significant way, at least on the investor side. So what should you do with this information? Maybe you're a home buyer, maybe you're an investor. I definitely come with more of an investor's perspective, but in any event, I would would say to take it one deal at a time. Even in a hot market, you can still get a property for below market value if you're patient and you jump on opportunities when you see them. That is always an opportunity in real estate, which is unique compared to many other markets that have a lot more sort of price consistencies and price efficiencies. Real estate is a pretty inefficient market compared to many others. You just got to focus on the deal at hand, and if it's a good deal, go for it. Now, for investors, realize that rent prices do not equal home prices. So even if home prices collapse, that doesn't mean that rent prices will collapse, especially if there's an interest rate hike, since that would typically mean that the affordability of the home is actually about the same from a payment perspective, which would mean that rents are probably going to stay pretty consistent too. That's not a guarantee, of course, but keep that in mind. The markets are not necessarily the same there. The rental market and the housing market themselves can be very different at times. But whatever the case, if you're a home buyer or an investor, don't over leverage yourself, since there's always a chance that the housing market will crash or even the rental market will crash, and then you're going to be out of luck if you have too much debt and you can't meet those debt payments or any expense payments for that matter, whether it be property taxes, insurance, and all the expenses that come with maintaining a property. If you're nervous, increase your reserves going into a deal, even if it means you got to save up for a few more months. It's probably worth it if it helps you sleep at night. But anyways, that's all I've got for today. If you like this video or found it informative, definitely like it, since that would help the channel out a lot. And as I mentioned earlier, definitely subscribe if you're interested in investing and personal finance content. I have a lot of real estate content as well, so be sure to subscribe so you don't miss any of those updates. And if you've made it to this point in the video, thank you, and until next time, take care.